Welcome. This is the chapter on option pricing on the book Elements of Financial Risk Management by Christoffersen. So this is chapter 10 on the book. In this chapter, what we're going to focus on is on option pricing models. We're going to see 4 types of models. The first one is going to be the Black-Scholes-Merton pricing model. The second one, it's going to be this Graham-Chalier that is going to correct for skewness and kurtosis. So the first one assumes the normal distribution. Third one is going to be an option pricing model under GARCH. So specifically, we're going to see this one with dynamic volatility. And the final one, that is the one that is used by practitioners, is the one of the implied volatility function. And that's going to be the fourth one. So first of all, let's do a quick review on option pricing and the several definitions. So first, we have a call option, a put option, and then this, you already know, the bond and the risk-free rate. So in here, what we have is the payoff of these different contracts. So the payoff of a call option is basically the maximum between S minus K, comma 0. So in here, K is going to be the strike. So let's write it here. K is the strike. So that's for the call option. So in this case, K would be here. So if you're below this K level, then it's 0. If we're above, then you start making money as S increases. Then for the put option, the payoff is going to be the maximum of K minus S, comma 0. So this here is the opposite. So in here we have K. And then for any value of S that is below K in all this range here, we're going to have a positive payoff. And if S is bigger than the K, than the strike value, then we're going to have a payoff of 0 for the put option. And then you compare this when underlying, so the underlying would be S. So in this case, that's the stock price. So the stock price, basically, if you buy it at here, 11.35, now if it goes up, you make money. If it goes down, you lose money, or it decreases its price. The second review is what we call the put-call parity. So the put-call parity is an equality that is established between, of course, a put and a call. Now, what is important to know here is that this put and this call, they have everything similar, meaning the strike is the same, the underlying stock is the same, the time to maturity is the same, hence interest rate is the same. So the only thing that is really going to change is the put value and the call value. Why would you need this? Well, let's say there's a case where you have the call price, strike, in this case X, before I've written K, this is K or X, then the interest rate and the time to maturity, and here you have also the underlying price. But the only thing that you don't have is the put price. So with this equality, you're going to be able to back out what the put price is. Let's see some basic stuff of option pricing models under the normal distribution. So the very first thing is that here we define the return as this function, normal, with this mean, mu minus 1/2 sigma square, and then the standard deviation is sigma square. I want you to realize that this is different to the old stuff. So for risk management, this is what we have used. So in here, we assume that ZIT was normal 0, 1, meaning that the return has a distribution for risk purposes that is normal 0 sigma squared. Then the basic story is going to be that, well, the price of a call, so you see this C here, it's equal to a call. It's going to be an expected value of the payoff. So before we said, oh, well, the payoff is going to be S minus X, comma 0. Here we have exactly the same thing, X or K. That's a strike. The price is going to be the underlying price, stock price at maturity, minus X. And then we're going to take an expectation. So basically, we're going to take an average of that price. And then the star, what it's signaling is that we're going to do this under something called the risk neutral distribution. And then once we have that expected value at maturity, we're going to discount it to present time with e to the minus rt, and that's how we're going to get the call price. Using this equality, Black-Scholes and Merton, they converted the formula. So here you have the expectation, and here you have the probability distribution for X, and they converted that formula into this formula. This is what we're going to call the Black-Scholes-Merton. How we're going to convert this is by realizing that X is going to be normally distributed. Again, you see that the mean is different than 0, and then it has some standard deviation that depends on time. And the final formula that they come up to is C from the Black-Scholes-Merton model. So it's going to be the underlying. This is going to be the cumulative normal distribution. This D is going to be this parameter D. Then here we're going to have the discounting. X is going to be the strike. And then sigma is going to be the standard deviation. And this is going to be the formula, the accepted formula for the Black-Scholes-Merton model. Using put-call parity, you can back out what the put price would be. Here we apply put-call parity, and then the put price under the Black-Scholes-Merton is going to be this formula. The main assumption that we have on the Black-Scholes-Merton is that the underlying, that means the S, is normally distributed. Now the question is this true? And the answer at this stage of the course is that no, it's not true. Okay, so this model is going to have several problems, and the main one is that S is not normally distributed. Still, there's ways to work around that problem, and we're going to see which ways do we use to work around the normality problem. Let's give an example of this Black-Scholes-Merton model. Here we have the underlying stock price. The stock price right now is 11.37. This is the strike price, 11.10. Time to maturity, 43 days. This is the risk-free rate. Again, the units would be in days. And here we're putting dividends. And this is the implied volatility, the sigma, or the volatility standard deviation itself. The very first thing we're going to do is we're going to compute the D, the value for D. We're going to compute D minus sigma square root T. We're going to put this under cumulative normal distribution, both of them. And finally, we're going to feed everything into the model. Call option should have a price of 42.77 given those inputs. How do we implement this model? The unknown in this model, so this is our model here, the Black-Scholes model, is sigma. Everything else you know it. You know S, R, X, T, and the dividends. The only thing that you don't know is the sigma. Then you retrieve call prices from the market, and you do a mean square error where you minimize trying to find sigma. Realize that in this very first example, the sigma is going to be unique. That means there's going to be one sigma to price everything. Well, that's what the model, Black-Scholes model, assumes, that there's only one sigma that should price absolutely everything. That means, because here what it's going to change is that X is going to be different. So there's going to be a range of X's. So this would be a quick example where we say, look, the call price is equal to 42.53. We take all the inputs and then we retrieve back this implied volatility. That means that when we feed this implied volatility into the Black-Scholes-Merton model, we're going to recover exactly this 42.53 option price. If we do this for all the options that change across strikes, then we're going to have the moneyness. So S is going to be constant, then X is going to change. That means we're going to have several different strikes. And then look here, let's focus on the 43 days to maturity. So the 43 days to maturity, this graph here, we have several different options. So we have one option with this moneyness. Then we have another option here with the different moneyness, and so on. So we have several options here, several options. And then when we go and compute the implied volatility, this is what we have in the y-axis. So this is the sigma implied volatility. And then we see that as the X decreases, that means the moneyness starts to increase. Then what happens is that you have to price with a higher and higher volatility. If you put some thought into this, then you realize that what this is correcting is exactly for normality. How? Well, by making these options more expensive, and then what this does is puts more weight on the normal distribution so that it's not normal anymore, and that it has some skew. So this thing is called the volatility smile, the option skew. So these are the several names that we give to this graph, and the fact that it's tilted as we change the strike price, then the volatility also changes. Now we move into the second model. The second model is going to allow for skewness and kurtosis. How? Well, it's going to be called the Graham-Chalier model. And this Graham-Chalier model does a Taylor series expansion around the Black-Scholes-Merton model to allow for skewness and kurtosis. So the very first part of the model, it's exactly, so this is exactly equal to the call under the Black-Scholes-Merton model. Now the second part here, it's going to allow for skewness. So this would be the skewness, and for kurtosis. You realize that if skewness and kurtosis are both equal to 0, then these terms are going to disappear. The second part is going to disappear, so the call Graham-Chalier is going to be equal to the call Black-Scholes-Merton model. Again, this is correcting for skewness and kurtosis of the underlying distribution for the stock price. How is this model going to be calibrated? Before, we were only calibrating for one variable, that was the sigma, the volatility. Now we're going to calibrate for skewness and kurtosis. We're going to also put the market prices, the Graham-Chalier, and we're going to minimize the difference between the two prices, the square differences, to find the volatility, the skewness, and the kurtosis of the model. If we compute the implied volatilities of this model, so we take the prices from the Graham-Chalier, and then we compute the implied volatilities under the Black-Scholes-Merton model, then what we're going to realize is that the kurtosis is basically creating the smile. So this is the volatility smile. So more kurtosis creates that smile. So basically at strike of 1, you have the lowest volatility. And then as you move into higher and lower strike prices, the volatility increases. And then the skewness, what it's creating is this smirk, and here the smile. So we see that this is a very good way of correcting it, and it actually creates that smirk that we saw before, which is the same thing than the volatility smile. The third model that we're going to see is the one with dynamic volatility under the GARCH process. So this is the RT in this case, which is going to be equal to all this. Realize again, this is the old one, the one we used for risk purposes. The two of them are very different. Option pricing under GARCH is going to have a very different process for the returns. Now, the volatility here is also going to be dynamic. We just realized that one of the problems under the Black-Scholes-Merton model is that sigma was constant. In here, what we're going to allow is volatility to change over time. And then this is going to allow for better dynamics of the return price, and the fact that volatility changes is going to make the returns to be not normally distributed. So this is actually what correcting for to have non-normality. The idea in this GARCH model is going to be to create several different S prices. How? By using Monte Carlo simulation. How are we going to exactly do that? Well, very similar to what we did before. So we have a process for the sigma. Given that we have this process for the sigma, then we're going to model several different paths for the returns. So this is the last thing we're going to get. So this is going to be the return 1 up to return Monte Carlo, let's say 10,000 paths for the stock price. How? By generating this Z's that are going to be 0, 1. Then they're going to generate new returns for day 1. Then we're going to have new volatilities for day 2. And then we keep going up to till day T plus tau. This would be the maturity. And then at the end, with all these returns, we're going to get this new S price. Given that we have this new S price, then we're going to compute the max S T plus tau minus K comma 0. We're going to take an expectation. So in this case, I'm going to write it as the average of all this thing. Then we discount e to the minus RT, and then this is going to be the call price under the GARCH model. That's the basic intuition on how this model works. How are we going to implement this model? Again, we have the market prices, and we have now our GARCH model. And this GARCH model depends on, well, this volatility, but that volatility depends on omega, alpha, and beta. And here we're going to have this extra parameter. This is the price of risk. It's going to be an extra parameter in all the equations. And just as before, just like we did when we did maximum likelihood estimation, we're going to estimate all these parameters to make the call price from the market equals or as close as possible to the call price under the GARCH model. The last model that we're going to see is the one used by practitioners, and it's called the implied volatility function model. How does this model work? This is the one used by practitioners. So the idea is we compute all the implied volatilities for each individual option. We're going to do all these options across different X's and different T's, so different strikes and different maturities. And then what we're going to do is we're going to fit this linear regression. So the linear regression varies on the strike squared, well, money squared, and then it's going to vary also on time and time squared. And then we're going to have this cross product between moneyness and time. The whole idea is that we do a linear regression where we find all these constants. Once we have all the constants, then from A0 up to A5, then we're going to be able to price any option that we want. A different way of doing the same problem would be to do a minimization between the market price and this function where we have all the parameters that we had before. So the sigma IV is that regression where we have the A vector that goes from A0 up to A5. And the whole idea is, well, let's try to find the A's so that it minimizes the difference between the market price and the call price under this implied volatility function model. we did all the models: Black-Scholes-Merton, Ramchalier, GARCH, and the implied volatility function model. 4 models to price options. Thank you for watching.